In 2024, the world ran a silver deficit of 148.9 million ounces. Not a rounding error, a structural shortfall equal to about 15% of global supply. And it was not a one-off. It was the fourth consecutive annual deficit. Industrial demand alone hit a record 685 million ounces, with photovoltaics at 197, 6 million ounces by itself. Silver was being consumed by the physical economy faster than the market was being replenished. That is confirmed in the Silver Institute's World Silver Survey, produced with Metals Focus. If you think this does not affect you, listen closely. Silver is embedded in the wiring of modern life, in power grids, in electronics, in solar panels, in data centers, in the devices in your pocket. When the price of a critical input starts moving violently, it does not stay inside a commodity chart. It travels into manufacturing costs, into supply chains, into inflation math, into interest rates, into geopolitics. Now here's the part that confuses most people. Even in a physical deficit, silver can trade like it is abundant. It can fall when shortages are discussed. It can spike when inventories look stable. It moves like a seesaw, up hard, down hard, often for reasons that do not seem to match the real world. This story is about that seesaw, what is confirmed, what is merely claimed, and why the mechanism behind silver's price is less about one secret actor and more about how a modern financial empire prices reality. This isn't conspiracy, it's visible in the plumbing. Silver has a global benchmark price set through a regulated auction in London. That benchmark is administered by ICE Benchmark Administration, using an electronic auction process with defined rounds and imbalanced thresholds. That is public methodology. It is not hidden. The auction runs at noon London time, and it exists to produce a single reference price for a web of contracts around the world. That is confirmed. The system uses an algorithmic process, rounds of price discovery, and a rule that the auction ends when buy and sell interest falls within a threshold. That's a mechanism, not a rumor. At the same time, a huge portion of silver trading happens through derivatives, futures, options, swaps. These instruments are not inherently manipulative. They are how miners hedge, refiners hedge, manufacturers hedge, and investors speculate. But they do one critical thing. They allow the market to trade paper silver in quantities that dwarf physical flows, because most contracts never result in delivery. They are rolled, closed, netted, or cash settled. That is not a scandal. It is the design of modern commodity finance. And then there's China. The title claims China revealed it. That phrase needs discipline. There is no single confirmed event in which China publicly revealed a secret lever that controls silver. What is confirmed is something more interesting. China operates major physical exchanges and futures markets. China is a dominant force in solar manufacturing and a major driver of industrial silver demand. China's trading venues publish rules, including clearing, settlement, margin controls, and default procedures. Those rules show how physical and financial settlement are enforced inside their system. That is real. That is on paper. So this episode will not chase a single dramatic revelation. It will map incentives, exchanges, benchmarks, and flows, and it will separate what can be verified from what is often claimed in precious metals circles. Because the truth is already dramatic enough. The core pattern is the seven-stage empire and monetary cycle. It is not mystical. It is a repeating set of constraints. Stage 1 is sound money foundation. Trust is high. Money is respected. Contracts feel stable. Stage 2 is expansion and social programs. The system grows. Trade expands. The state promises more. Stage 3 is military overextension and debasement. Costs rise. Debt rises. Money becomes more political. Stage 4 is desperate resource acquisition. The system needs inputs, energy, metals, shipping lanes, strategic stockpiles. Stage 5 is loss of confidence, not overnight. Quietly, first in the margins, then in the core. Stage 6 is fiscal dominance. The state's financing needs begin to steer monetary policy, not the other way around. Stage 7 is collapse and reset, usually not total collapse. A reset, a devaluation, a new regime of rules. Silver fits into this cycle in a specific way. Gold is the ultimate monetary metal. Silver is the hybrid. It is monetary history, industrial present, and energy transition future at the same time. That makes it unstable, and that instability is exactly why the seesaw exists. Now, 3 case studies. 3 moments when a system's constraints forced a reset. Not because people were irrational, but because math eventually wins. First, the late Roman Empire. Rome's early power rested on credible coinage and expanding trade. That was stage 1 and 2. But expansion created obligations, armies, grain distributions, administration. As the empire strained, debasement entered the coinage system. That was stage 3. The state needed spending power more than it needed purity. Confidence eroded, prices rose, trade became harder. Tax collection became more aggressive. Wealth shifted into land, real assets, and anything the state could not dilute easily. That was stage 5 and 6 in ancient form. The consequence was not a single day of collapse. It was a long loss of monetary coherence, followed by political fragmentation and resets in how value was stored. Second, Spain's imperial era. Spain's global reach expanded with extraordinary speed. Stage 2. But imperial logistics are expensive. Wars are expensive. Debt is expensive. Silver from the Americas flowed into Europe and became a monetary engine. But that abundance did not create lasting stability. It created dependency. The empire's fiscal structure became vulnerable to external shocks, shipping disruptions, and the rising costs of maintaining dominance. Confidence and credit cycles became Spain's invisible battleground. The consequence was recurring financial crises, defaults, and the gradual transfer of financial primacy to other centers. The system learned that controlling metal inflows is not the same as controlling the balance sheet. Third, the United Kingdom's transition in the early 20th century. Britain's era was built on trade, industry, and the pound's credibility, stage 1 and 2. But the cost of global conflict and maintaining an empire strained fiscal capacity. Stage 3. The gold standard constraints, war finance, and post-war adjustments produced pressure on reserves and confidence. Capital moved. The monetary center of gravity shifted. The pound's role diminished relative to the rising American system. The reset was not just about currency. It was about who provided the deepest markets, the safest collateral, and the most reliable settlement infrastructure. Now apply the framework to today. The modern global system is built on the US dollar, US Treasury collateral, and the deepest derivatives and funding markets in the world. In foreign exchange turnover, the dollar is still on one side of 88% of trades, according to the BIS Triennial Survey. That's not a detail. That is dominance in the pipes of global finance. The system still clears in dollars because the world still settles risk in the deepest pool. But reserve dominance and fiscal dominance are not the same thing. The U.S. fiscal trajectory, as projected by the Congressional Budget Office, shows persistent large deficits and a rising debt to GDP path over the coming decade, with debt held by the public projected to rise further in their baseline outlook. Even without dramatizing it, the structure matters. When interest costs grow, the political tolerance for high real rates weakens. This is where fiscal dominance pressures appear, not as a headline, as a constraint. Meanwhile, official reserve composition is slowly changing in the margins. The IMF's COFARE data tracks currency composition of official foreign exchange reserves and has documented a gradual decline in the dollar's share over long timeframes, alongside diversification into other currencies. That does not mean the dollar is finished. It means the world is testing options at the edges while still relying on the core. This is the environment where silver becomes explosive. Because silver is priced inside the dollar system, but demanded increasingly by an industrial system that is rewiring the planet. And that industrial system is heavily centered in Asia, with China as a key node in solar manufacturing and broader electrification supply chains. Here are the confirmed supply-demand facts that create the pressure under the seesaw. In 2024, total silver supply was about 1,015.1 million ounces, and total demand was about 164.1 million ounces, producing that 148.9 million ounce deficit. In 2025, the Silver Institute and Metals Focus forecast another deficit of about 117.6 million ounces, with total supply rising to about 1,030.6 million ounces, and total demand easing to about 1,148 million ounces. Industrial demand is forecast to remain near record levels, with photovoltaics still near 195.7 million ounces. That is the physical narrative. A persistent structural deficit driven by industrial usage, especially the energy transition. Now the seesaw mechanism. To understand silver, forget the idea that there is one price. There are multiple prices stitched together. There is the London benchmark, discovered through an auction with rules. That benchmark anchors an enormous range of contracts. It is designed to be a reference, not a prophecy of scarcity. There are futures markets that translate physical risk into financial form. Futures are vital because they allow hedging and liquidity, but liquidity also means leverage. And leverage means that short-term price can be set by marginal flows of capital, not by marginal bars of metal. There are physical exchanges and settlement systems with their own margin rules and default procedures. China's Shanghai Gold Exchange publishes detailed rules describing centralized clearing, margin requirements, and settlement processes, including the exchange's authority to take risk control actions and default resolution measures. That is not a revelation. It is an institutional blueprint for how they enforce settlement discipline in their marketplace. So where is the seesaw? It is in the gap between financial silver and physical silver. When macro capital wants safety, it often buys gold first. Silver lags because it is smaller, more volatile, and tied to industrial cycles. The Silver Institute's own analysis notes that in recent years, macro and sovereign participants have been more comfortable with gold's market depth and quasi-monetary status than with silver's smaller market and industrial attributes. That matters. It helps explain why silver can underperform gold even in a deficit. Then, when risk appetite returns, silver can surge because it is high beta, smaller market, less depth, faster moves. That is one axis of the seesaw. Macro money in and out. The second axis is inventory psychology, because deficits do not immediately mean no metal. They mean above-ground stocks are being drawn down. If above-ground stocks are perceived as plentiful, price can remain capped for a time. Then, when the market senses that drawdowns are tightening availability for specific forms of deliverable metal, price can gap violently. And the third axis is benchmark and derivative gravity. The global benchmark and major derivative markets create a gravitational center. If physical demand rises in one region, metal flows can adjust. Arbitrage tries to equalize regional dislocations. But arbitrage is not free. It depends on shipping, refining, bar formats, vault availability, financing costs, and sometimes regulation. This is where China's role is often discussed in exaggerated terms. What can be said responsibly is this: China is a major industrial consumer of silver through supply chains tied to photovoltaics and electrification. China also has its own domestic trading and settlement infrastructure, with clearly published rules. When a large industrial system has both rising demand and functional exchanges, it can influence how physical metal is bid, financed, and stored inside its borders. That can change global flows, not by revealing a lever, but by operating a parallel center of gravity for physical demand. In plain terms, if China's industrial system needs silver, it will pay for it. And if global prices are set primarily by derivative liquidity elsewhere, sustained physical bidding can eventually force convergence. But the path is not straight. It is a seesaw. Financial pressure can push price down while physical pressure quietly tightens the market underneath. Now address the silver slam to $75 part. A specific price target is not a fact. It is an outcome scenario. It cannot be guaranteed. Silver can hit any number under the right conditions, but responsible narration must treat it as conditional. The better approach is to explain the mechanisms that could produce sharp moves, and the measurable indicators that would make them more likely. So what happens next is mechanism, not prophecy. If industrial demand remains structurally high, as the Silver Institute and Metals Focus Project, and if supply growth remains limited, deficits persist. If deficits persist, above-ground stocks tend to be drawn down unless investment selling offsets it. If interest rates fall or real yields decline, precious metals often gain support. But silver's reaction depends on whether the market frames the move as growth-friendly or currency-protective. If it is currency-protective, silver can catch a bid after gold leads. If inflation reaccelerates while policy credibility weakens, silver can act like monetary metal. If growth slows sharply, silver can trade like industrial metal. That is its dual nature. That is why it whipsaws. If regional price dislocations widen, physical metal moves. If metal moves, it stresses specific vault categories and delivery expectations. And if delivery expectations tighten at the same time, speculative positioning is crowded, the market can produce violent spikes and equally violent reversals. That is how silver has historically behaved in multiple episodes. And if, at the same time, fiscal dominance pressures increase in the core reserve issuer, trust debates intensify, not in one speech, in behavior, in allocation, in hedging, in the slow shift from return on capital to return of capital. Now the objections. The three ways people dismiss cycles. First, technology will save us. Technology changes tools. It does not remove constraints. Empires have always had advanced technologies for their era. Rome had concrete and logistics. Spain had oceanic navigation and bullion flows. Britain had industrial power and global shipping. The US has digital finance and deep markets. Technology can postpone stress by improving productivity, but it can also accelerate resource demand. The energy transition is a technological story that increases demand for specific metals. Silver is one of them. Technology is not an escape hatch. It is often the amplifier. Second, they can print forever. States can create currency units. They cannot print real resources. They cannot print trust. Printing can stabilize a crisis in nominal terms, but it often shifts the burden into purchasing power, distribution conflict, and asset inflation. Over time, that feeds the cycle's later stages. Printing forever is not a plan. It is a trade-off. And the trade-off shows up in real assets, in commodities, and in the risk premium demanded by capital. Third, reserve status prevents collapse. Reserve status buys time. It does not repeal arithmetic. The BIS data shows the dollar's dominance in FX trading. The IMF data shows it remains central in reserves. That is real power. But reserve status also creates temptation. It allows larger deficits. It allows externalization of costs. It allows a bigger financial sector. Eventually, the system faces the question, can the issuer maintain credibility while financing itself at scale? If the answer becomes uncertain, the system does not instantly collapse. It starts pricing a higher risk premium. It diversifies slowly. It demands more collateral. It shortens duration. It hardens terms. That is how the late stages appear. Quietly, then suddenly. Now, practical takeaways, without pretending to offer personalized financial advice. First, think in balance sheets, not headlines. Households and businesses survive volatility by managing cash flow, liquidity, and obligations. The biggest risk in any cycle is forced selling. Forced selling comes from leverage, short-term debt, and fragile income. Second, diversify conceptually, not just across tickers, but across risk types: rate risk, currency risk, job market risk, supply chain risk. A portfolio is not only investments, it is skills, savings buffers, and flexibility. Third, respect liquidity. In stress, liquidity becomes expensive. It is not glamorous, but it is survival. Keeping a buffer can prevent panic decisions when the seesaw swings. Fourth, avoid information contamination. Precious metals attract sensationalism because they sit at the crossroads of finance and distrust. The discipline is simple. Separate what is confirmed from what is claimed. Use official data where possible. IMF for reserves, BIS for FX turnover, major benchmark administrators for methodology, industry surveys for supply-demand. If a claim cannot be verified, label it and move on. Fifth, watch indicators, not predictions. Industrial demand trends, photovoltaic demand trends, persistent deficits, real yields, dollar funding stress, regional price dislocations, inventory drawdowns. These do not tell you the price will be X. They tell you whether the system is tightening or loosening. And now the ending. Silver is not just a metal, it is a stress sensor. It sits between money and machines, between safe haven and supply chain, between London benchmark gravity and industrial reality, between paper leverage and physical constraint. That is the seesaw. The verified facts are already enough to justify attention. A fourth straight year of deficit in 2024, another deficit forecast in 2025, record industrial demand, photovoltaics consuming nearly 200 million ounces a year, and a global pricing system anchored in benchmark auctions and derivative liquidity that can overpower physical signals in the short run. The claim that China revealed it is not confirmed as a single event, but China's role is visible in structure, in demand, in manufacturing gravity, in exchange rules that show how settlement discipline is enforced. The story is not about a secret switch. It is about two worlds trying to price the same metal, a financial world that trades claims, and a physical world that consumes atoms. And when those worlds drift too far apart, the market does what it always does. It snaps. If the pattern holds, the next major move will not arrive as an announcement. It will arrive as a mechanism. Tightness, dislocation, then repricing. In the next video, the focus will be on the indicators that historically signaled a shift from paper dominance to physical dominance in commodity markets, and which assets have preserved purchasing power during monetary resets without pretending any outcome is guaranteed. So here are the questions. What do you believe sets silver's price in the short term? Money flows or metal flows? And if silver is both an industrial necessity and a monetary hedge, which side of the seesaw do you think wins next?